Hello, everyone. Today on the final bar, we will focus on how this week has evolved in 4 trading days in. The S&P, the major averages, recovering quite a bit going into the close, but a lot of the damage done out of the open. We're going to look at how the S&P down 0.5% relates to the overall longer trends with a reversion back to the previous trends that had been in place. Energy rebounding nicely after yesterday's distribution. The growth at the bottom. Ladies and gentlemen, this is the final bar. Everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market activity using the power of StockCharts, using the technical analysis toolkit to better quantify investor behavior, better understand market dynamics, and learn the lessons of market history. It's a volatile period by any definition. The VIX continues to remain elevated, remaining above 30. A lot of choppiness, a lot of movement, changes of course in midday, which is what we saw today with the major averages. At the end of the day, what technical analysis is really helpful for is to help you understand the different relationships of the time frames. There's a short-term, a tactical time frame, which is what today's trading day really is showing, right? The short-term movements, the fluctuations, the buys and sells and how they relate and how they push prices up and down. But remember, all of that activity is also part of the longer term trend. And what we try to focus on in the show are those longer term characteristics, focusing on the market cycle, focusing on the secular trends and how today fits into the big picture. So we'll look about this overall movement. Some key stocks like Apple and Amazon finding support so far, but with some clearly defined support levels that we should all be paying attention to just in case they get broken. We have great guests on the show. Had a lot of fun this week with our guest appearances. Next week, 3 really good ones lined up for you. On Tuesday the 15th, we have Samantha LeDuc from LeDuc Trading. On Wednesday, March 16th, Bob Lang from Explosive Options. On Thursday the 17th, Clint Cowles, who's a strategist at TD Ameritrade in Minneapolis. Also, so you know, our next version of Chart Madness, a bracketology March Madness themed stock picking exercise, will be later this month on March 24th. I will be part of a 4-person team breaking down a bracket of 16 stocks, picking our favorites, and then coming up with our final 4 and our champions based on the technical characteristics that we interpret. Go to stockcharts.com/chartmadness for more information. You can actually download a bracket today and fill out your picks and see how they match up to the 4 experts on that special show. Let's continue on with our next segment. We're going to wrap the week here a little earlier. I'm off tomorrow. We're actually going up to Snoqualmie Pass, which is one of the passes through the Cascade Mountains, with my family doing some winter sports here as we wind down the winter months and get up in the mountains. So let's wrap up what the week has done so far. Today, the S&P finishing down about 0.4%, although the S&P had gotten down to around 4210 earlier in the trading session. Technology really weighing on the markets today with the XLK down almost 2%. It was down more earlier in the day. The NASDAQ composite finished down just under 1%. Mid caps and small caps actually flat for the day. So while large caps were down about 0.4%, mids and smalls actually made it back to the 0 level right in time for the close. And the VIX down a bit, still above 30, which has been sort of that representative level indicating an elevated volatility environment. Other asset classes here to highlight. We have the Fed meeting coming up next week, so interest rates have been a part of the story, I think, for quite some time, but will certainly become more and more a part of the conversation going into next week. We have updated inflation numbers that show persistent elevated inflation, continue to be a challenge we're all dealing with at the gas pumps, but elsewhere as products are becoming more and more expensive. Interest rates popping higher today with the 10-year yield getting back above 2%, which is a noteworthy one. It had come off here recently around the invasion of Ukraine, now popping back to the upside, and the 10-year getting right back above 2%, not far off of the high level that we've seen in the last year. The dollar index back up about 0.5%. That's after yesterday was selling off quite a bit. So the dollar index rebounding, regaining the highs from yesterday, and then following through a lot higher to the upside. Again, finishing up about 0.5% using the UUP. Gold and silver both up on the day. Oil prices actually lower, although the energy sector did just fine with the XLE up 3%. Now that's after a pretty big drop yesterday, so it was a bit of a mean reversion yesterday, now sort of popping back up and continuing that pre-existing trend. Cryptocurrencies have truly been all over the place. So yesterday, big move higher, and this was President Biden had signed made some announcements relative to regulation of cryptocurrencies, how I would summarize the general theme of that. Popping up to 42,000 on Bitcoin, now right back below 40,000. That's an important level to watch. I would say big round numbers for Bitcoin have ended up being fairly important. So 20,000, 30, 40, 50, all the way up have ended up being support and resistance both ways for Bitcoin. So Bitcoin, Ether both down today, and all 10 of the major coins that we follow all in the negative. We're going to come back to a chart of the S&P only because a little later we're going to look at the Mindful Investor Live chart list and go through some of those key charts to pay attention to. What I wanted to do now is just look at how the week has played out so far. So as of Thursday's close, the S&P comes in down about 1.6%. Now that's that black line that you can see there. A couple things underperformed the S&P so far this week. In pink, we have the NASDAQ 100, not too far off, down about 1.8%. This is emerging markets down 2.7%. In red, we have bond prices down 4.1%. The worst performing asset of all of them, crude oil, down 6.8%. That's using the USO. This is all using ETFs. Most of them are using ETFs to track those major assets. Everything else has outperformed the S&P so far this week. The dollar index essentially flat, right at the zero level for the week. In purple, we have small caps, the Russell 2000, up 0.6%. Bitcoin so far is up 1%, but that's after a pretty choppy run of it this week. And then gold so far, the best performer today, beating out Bitcoin and up 1.5% for the week. So we'll have to see. Obviously, a lot of movement. Things can change very quickly through tomorrow's close and going into the weekend. You could certainly see some fluctuation, but that's where things are netting out. So relative to some of the other pretty significant directional weeks, this has been more of a choppy week. A lot of things up and then down, or down and then up during the course of the week. So we've talked about the conditions of elevated volatility. That certainly doesn't seem to be stopping anytime soon. Seeing plenty of movement in major asset classes. At this point, I'll just share with you some of the charts from the Mindful Investor Live chart list. And as a reminder, this is a list of charts that I keep updated on StockCharts.com. If you've not seen the show before, if you go to the Articles tab at the top of our website where it says All Stock Charts Blogs, go to mine, which is called The Mindful Investor, and you'll see a gray button at the top that says Live Chart List. If you click on that, it'll get you to this list of charts, which we'll review together now. So the market trend model that I have run for years is looking at 3 different time frames, and it's trying to look at the trends essentially on the S&P in those 3 different time frames. It is not by design a predictive model. The goal is not to necessarily use this to anticipate what's next. It's meant to define where the trend is right now. Now, trend following or momentum investing is built on the fact that existing trends tend to persist, and that's why it's so important. While we talk about this being based on lagging data, which is absolutely true, there is some predictive capability on the fact that trends tend to persist. So by tracking the trends and identifying when they turn, overall you're going to be on the right side of things. So where are the trends right now? The long-term model for me has been bullish for about a year and a half. This is maybe a little more. This is going back to June of 2000 that it turned positive, and from there has remained positive. You can see it's been narrowing really for the last year almost. It's been getting closer and closer to that important zero line. It's only been bearish twice in the last 5 years, once in March of 2020, the second time in December of 2018, the two, obviously steepest corrections we've seen, besides the current one, arguably, depending on where this ends up bottoming out. My medium-term and short-term models have both been negative. Now, if you get a big rally tomorrow going into the weekend, the short-term model could theoretically turn positive, but it would have to be a pretty significant move. The spiders would have to close above 434 and change, which is another 10 points above where it is right now. It's not a small move, so you'd have to have a big rally going into the weekend to trigger a buy signal there. Medium-term model, pretty much impossible to turn bullish, although we could start to narrow it and get a little less bearish. So overall, I would assume the model remains consistent, short-term and medium-term bearish, long-term bullish, and that's about how the market feels right now. And again, this model for me was meant to mirror the subjective analysis I was doing looking at a bunch of charts like this. I see the short-term and medium-term trends as both fairly weak right now, although we're still not that far off of all-time highs. The daily chart of the S&P is an interesting one. You know, on Tuesday's close, we actually closed below 4,200 and really accelerated to the downside. This is a new closing low for the year. So the fact that we're making new closing lows this week tells me I'm going to assume we're not at a bottom yet. I think the chart will tell you when a bottom is in place because we stop making lower highs, we start making higher lows, we start to revert a higher. We made a higher intraday low, but on a closing basis, we actually pushed even further down so far this week. So 4,200 has ended up being a pretty significant level. We first touched this green shaded area back here in January. We hit it again in February. We opened below there, but closed right above it, which was a nice short-term bottoming signal. On Tuesday of this week, we closed below it and again have propelled back higher. So 4,200 is serving as quite the floor for the market. What's interesting about that is if you take the low from March of 2020 and take it to the high of January of 2022, 38.2% of the way back down is right at that same level, 4,200. So I have a lot of confidence that that is a key support level. The fact that we've closed below it, I think, tells you that the weight of the evidence overall is more negative than positive, but you want to see some follow through, and that's what we've not quite seen yet. You haven't seen, you need a close below and then sort of a follow through, an indication that we are continuing in that direction. You're not quite getting that satisfaction yet if you're on the bearish side, which I would describe myself as being. Now, when you look at breadth conditions, overall they've been pretty negative. I think my conversation yesterday with Jonathan Krinsky from BTIG was an interesting one. He talked about the breadth conditions getting negative. We were looking at a different indicator, the percent of stocks above their 200-day. But his comment was that while breadth has been negative, it hasn't gotten completely bombed out, and that real negative breadth reading is what you usually get at a significant market low. His takeaway from that is because we haven't had that bombed out breadth yet, we're not at a low yet, and I would tend to agree with that idea, with that thesis that the low is most likely not in because we haven't seen the acceleration of some sort of capitulation in the breadth readings. Overall, they're just sort of consistently negative. It's worth noting, by the way, this is not quite updated for today's close just yet on Thursday. But as of Wednesday's close, the S&P advanced decline line had not broken below its December low. All the other ones have already done so. So I think particularly the NYSE breadth has been negative for quite some time. I think that's confirming this down phase that we're in. The only one that really hasn't confirmed it yet is the S&P, and that's an important one that I will continue to watch and see if and when that might be triggered. Now, when I was talking with Jonathan yesterday, we were looking at a chart similar to this one. We're looking at the percent of stocks above their 200-day moving average. Here we're looking at the S&P members. As of yesterday's close, 40% of the S&P remaining above their 200-day moving average, only 29% remaining above their 50-day moving average, which is very close to a new multi-year low for that indicator. So overall, what this tells me, these pink horizontal lines are right at 50%. If we are above 50%, overall, the average stock is in a good technical position. If it's below 50%, overall, the average stock is in an uncomfortable or a negative position. They're both clearly below 50%. I would say if you are bullish and if you're looking for confirmation of a recovery, I would want to see these indicators get above the 50% line. You're not seeing it right now. You're also seeing an expansion in new lows. We're starting to see more and more new lows, and these are not just new swing lows. These are 52-week lows, which means the stocks have really gone down quite a bit and unwound all of their returns for the last 12 months. Now, some stocks, it's not hard to do that because they've been in a bit of a downtrend. I sent a note out on social media earlier today about IPOs and try to find an IPO from the last year or two that has actually been a worthwhile investment. It's a challenging prospect because any that I would come up with off the top of my head are down and are pretty much at or near the lows for the year. So these are the types of stocks that are making new 52-week lows. Those sorts of names, particularly speculative growth names that have been leading the way to the downside in sectors like technology and communication services. We had seen an increase in new highs, which is an interesting one. A lot of that indicator's come down in the last couple of days, and we'll have to see if you get an exertion, a re-exertion of new highs. because a healthy bull market phase has an expansion in new highs. That would be another all clear sign that I'm not seeing yet that I would want to see. Well below half of the S&P members are in a bullish point and figure configuration, which is noteworthy. The more we spend time below 50%, the more that this is looking less like a buyable dip and more like an extended bear market phase, which is how I'm inclined to label this current market environment. Quick check-in on sentiment readings. We talked about the volatility continuing to be elevated, which is true. In terms of survey data, the AAII survey bulls coming down a little bit from around 30% to around 24% this week. An increase in bears, currently around 46%. It's not the highest reading we've seen in bears and not the lowest reading we've seen in bulls, but it's close, and that's what I would tell you. Overall, we are seeing a configuration in this sentiment indicator that is similar to bear market phases. I can't help but notice, though, after the eventual market low in March of 2020, look how long you had net negative sentiment. Bears outnumbered bulls for quite some time, almost 6-7 months before it actually went back above zero, and that's something worth noting. If you're looking for this to bottom out first, you might be waiting a little too long. The market usually recovers, and there's a disbelief phase on that first leg higher, which we haven't obviously seen yet. Name exposure index is looking at active investment managers up a bit. We were down below 30% last week. We're up to 43% allocation to equities. This is still very low and in line with previous bear market moves, but more corrective phases. The Rydex flows have actually continued to increase, and this is plotted inversely. What that means is when these bars are very high, when the bars are the histogram is very low, that basically tells you that investors are all bulled up. They're on the bullish side of the Rydex family. They've actually been getting more defensive. People in the Rydex families have been moving to the more defensive areas of the Rydex funds, which tells you that people are not buying into these bounces in general. We are lightening up our exposure to equities. We need to take a quick commercial break. Back answering your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we focus on the market environment using the power of StockCharts, using the technical analysis toolkit and best practices of the technical analysts to better understand what is happening around us as investors. A couple quick announcements before we get to the Final Bar Mailbag. First off, we welcome your questions. All the questions we're going to be sharing with you here in a moment are ones we received from you in the last couple days. Keep them coming. We love to hear your feedback and your questions on the markets and on technical analysis. Our email is thefinalbar@stockcharts.com. Our Twitter handle is @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air Tuesday of next week. Also, go to StockChartsTV.com. That is our on-demand platform. It is completely free. Special events like The Pitch, our upcoming special, Chart Madness, and many other great guest appearances like some of the conversations I've been able to have this week, all on demand for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Let's move on to our next segment, the Final Bar Mailbag. We're doing it on Thursday this week. We wanted to get to some of the great questions you all have been sending in. Let's get to question number one. Someone in the public chart list suggested a while back that there's a possible bearish Virginia formation in the S&P. See link below. I know nothing about this pattern, and it's not in chart school to my knowledge. Anything you can tell me about it would be helpful. So this is going to be interesting. The reason why I wanted to answer this question is to remind all of you about the public chart lists. There's some really widely followed and very well done chart lists. These are all chart lists that people like you, users, premium users of StockCharts.com have set up, and allows them to share commentary and share ideas with the community. And I think it's fantastic. This is one of the most widely followed ones that we have by a gentleman, David LaRue, who I actually don't know David. I reached out to him to ask him what a bearish Virginia formation is because, to be honest, and this is rare that I would say this, I have no idea. I've never heard of that formation. I've asked some of my peers in the industry, and none of us are familiar. So I'm guessing It is something that David has coined and is labeled on the chart. If I do hear back from him, I will share with you what I hear back. But if any of you do know, would you write into the show, the final bar at StockCharts.com, and point me somewhere? I'd be happy to share that insight. And boy, it's awesome to still be learning after a couple decades in the financial industry. I'd be thrilled to learn more about what that pattern is. As a reminder, though, our public chart lists are really some really cool content in there. I like following Walter Deemers. He ran the technical research team at Putnam Investments in Boston in the 1970s, and he's still updating charts on our website. To get there, go to Charts and Tools, select Public Chart List, and you can see this list along with many, many others. Our next question, on the S&P 500, why are you using Fibonacci's from the September 2020 low and not the March low in 2020? That's a really good question. So what I'm going to do, this is the daily S&P chart that I would usually use, and I've hammered in, I feel like many times this 4,200 level because it's, I would argue, so important. Let me go back a little bit further, and I'll show you a couple different looks here. So depending on where you start the clock, you get some very different levels, right? So if, and I would say the systematic part of Fibonacci relationships is that the percentages are pretty well documented, right? 38.2%. 61.8%, those are pretty steady and those are pretty consistent. So if you're using Fibonacci retracements, you're using those levels. The subjective nature of Fibonacci retracements, though, means it's up to you to decide where you actually identify levels or what levels in particular that you would select. So I might pick a very different low than you would, right? You might actually decide the March 2021 low is really important for some reason, and that's where you would start the 0%, that's the 100%. What I usually coach people is look for the most significant turning points, right? Sort of the significant support and resistance levels and use those as an anchor point to your analysis. So I see September 2020 as being a pivotal moment because you had the big run, the V bottom out of March 2020. We had this consolidation in June, then the big move higher, then a 2.5 month sideways pattern, what's called a coil pattern or symmetrical triangle pattern of lower highs and higher lows. And when that resolved to the upside in November, that was a real all clear signal that paved the way for 2021 to be an exceptionally strong year for stocks. So because the market spent a couple months right with that as a low, I decided that was a good starting point for the analysis. You take that low, you take the high from January, 38.2% is right at 4,200. Now this is where it gets really interesting. If you actually take the March 2020 low, which you can see, if I back up the chart, I'm looking at that too. It's just so far away from the current level, so I don't talk about it too much. I've mentioned to my premium members of Market Misbehavior, my downside target now that we've broken 4,200 is 3,800, and I base that on a couple different things. One of those being a confluence of support. So that would be a 61.8% retracement of September 2020 to January 2022. It would also be a 38.2% retracement of March 2020 to January 2021. You can see they both line up right around here, right at 3,800 and change. And that's why that would be sort of the downside target I would give, assuming the fact that we break 4,200, which we appear to have done, assuming we get further follow through to the downside. So it is a subjective form of analysis in terms of which levels you pick. Those are the key levels that I've been using and why I've been talking about them on the show. Our next question, Larry Williams likes to say that he wants to use techniques that help him look forward rather than those that tell you where you've been. Nearly all the stock charts indicators are backward looking. Do you use any forward-looking tools? Far be it for me to disagree with an exceptionally talented and successful trader and analyst like Larry Williams. So I will yield to his expertise anytime. And you're absolutely right. And what I would tell you is, Larry, at times has worked very closely with Tom DeMark. They've had a lot of overlap in their careers over time. And I've gotten to know both of them over time, and they're both incredibly knowledgeable, and they both focus on forward-looking forms of analysis. Their goal is to anticipate when a turn is coming and try to take advantage of that. I will tell you that the technical toolkit really comes into, you can bucket most things into one of two categories. An indicator is either a leading indicator or it's a lagging indicator. The type of trading or the type of investing that I am essentially describing through the course of the final bar is a trend following technique. It's a momentum based trading system, which means you are selling things when they break down, meaning you're selling when an indication is confirmed that something's in a downtrend. You're buying when things are breaking out. You're buying strength and you're selling weakness. What Larry and Tom and others are trying to do is much more of a mean reversion type of strategy where you're actually trying to buy weakness and sell strength. I would love, would you say which one's better than the other? I'd say they're both different and both can be very successful, assuming that you have a good process and good risk management, good money management capabilities. But an example of the type of leading indicators that I would use would be something like a bullish momentum divergence. I'm showing you the chart of Amazon right now because I think it's a pretty good example of that. And what's interesting is the chart of Apple has a similar pattern. The S&P 500 arguably has this pattern where you have a low in January, a lower low February and or March, and the momentum is actually sloping higher. So you get this confirmation as the trend is going down. This is a leading indicator telling you that the price is going lower, but the momentum, the negative momentum, is actually dissipating. So what I do with that information is I say, all right, there's a bullish momentum divergence. I don't really care a lot about that until I get a valid confirmation, until I get some validation, some indication that the price is actually following through with that leading indicator. So I like to combine a leading indicator like a divergence with a lagging indicator like breaking through resistance or breaking through a trend line or breaking through a moving average. Those are the things that would confirm for me that things are turning. Now, if you're a more aggressive trader, you can take an early position, take half a position, take an entire position on the divergence and just use money management techniques, risk management to define your loss and minimize any pain if your call was wrong. It's all a preference and a different way that we would approach things. So for me, divergences would be one example of a leading indicator that I tend to find very valuable. Larry Williams, by the way, has premium tools on our StockCharts ACP platform that are fantastic, and I encourage you to check those out as well. We need to wrap today's show and go to the 3 and 3. 3 charts, 3 minutes. Here we go. Chart number 1 is looking at the NAAIM exposure index and the Rydex bull and bear flows. When we talked about sentiment as part of our Wrap the Week segment today, we looked at how these charts have evolved over time. The NAAIM exposure index has been increasing just from last week. Last week was one of the lowest readings we've had in a couple years, and is one of the many things that confirms to me that we are still in an overall a bearish configuration. Right? There's a lot of disbelief that any sort of rally is meaningful at this point. It's more about remaining defensive for money managers, is what that indicator is telling you. The Rydex flows show you that investors in the Rydex family of funds were the most bulled up, were the most bullishly positioned in mid-December, and from there they've been steadily taking off those bullish bets and getting more into cash and money markets. So it's interesting that you see the rollover. The market's essentially topped out in November. Most stocks topped out there. You can see that investors remained on the bullish side of that family, but now in the last 8 or 9 weeks have consistently lightened up or gotten a little more defensive. There's still a lot of room for that to go to continue to illustrate that investors are getting more and more defensive over time. Chart number 2 is the 10-year yield. You know, we've stopped talking about interest rates for a little bit only because we've had so many other narratives. The events in Ukraine with Russia and Europe and all the ripple effects of that, energy prices, inflation, all of that I think have distracted people in some ways and reasonably so away from interest rates. I think we're going to get back in the next week to a very interest rate focused dialogue because we have the Fed meeting next week, which certainly has the potential to move markets with potentially the first rate hike of many to come. So it's worth noting that the 10-year yield broke out above 2%, came back down, and tested the high from the first quarter of 2021 before reverting back to the upside, and the 10-year yield is back above 2%. That should fuel value over growth, which is certainly what we've been seeing year to date. Last chart of the day to show you here in our 3 and 3 is Amazon. And we've looked at Apple yesterday. We had that chart as one of our 3 and 3. We talked about that level of support. I actually recorded a video for my YouTube channel just a couple hours ago called Market Misbehavior. We focused particularly on Apple. Level of support, I think it was around 155, and why that's such an important level. For Amazon, it had the news, obviously, about the 20-for-1 split, talking about buybacks, and the stock is jumping over 5% at the close today, which is a nice rally. What's interesting to me, though, is this comes after a bullish momentum divergence. Lower lows in price, higher lows in RSI, oversold the first time, not oversold the second time. It's usually a pretty decent bottoming pattern. Now, what would you look for some confirmation that this actually has some follow-through, actually has some legs? 2 things I would be looking for: a break above the 50-day moving average, which would be something different from what we've seen year to date, and a break to a above trendline resistance, taking the high from November and the high from February. You see that happen, certainly a bullish indication. Folks, that's a show for today. Thank you so much for joining us every weekday after the close for the final bar. All of our previous episodes on StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.